Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending November 29th, 2024. So this week, a more, let's say, educational economic review. We're going to be talking about tariffs, trade tariffs, the threats that Donald Trump sent on social media Monday night. Moved the market a little bit, mostly moved the Canadian dollar, but other than that, the reaction was rather muted. The political machine has started moving in reaction to those threats. Here we'll present the facts, the numbers, the trade relationship between all of the countries, the impact of tariffs, and why we think that it would be a severe shock for sure if we went with 25% blanket tariffs in Canada and in Mexico, adding 10% on China for sure, but why we think that the odds that we get there are pretty low. They're never zero. We're not taking this for granted, but still the odds are pretty low. So title here says it all, Trump 2.0. Here we go again. So if you've read the book The Art of the Deal by Donald Trump, you'll know that one of the modus operandis that he has is that you need to create options for yourself when you're negotiating. And that means that you need to throw stuff out there just to see how the opponent will react, and by doing this you have a view of how maybe I can get a few concessions here, maybe I can get him moving that way, and then after that you get to the negotiating table. So it sounds and it smells like this quite a bit this week. Remember that Donald Trump was the one who pushed for the renegotiation of NAFTA. Now we have the USMCA deal in place. That was his initiative, and if he goes with those tariffs, that would go against the trade deal, so it would be illegal, but countries can get out of trade deals. We've seen that in the past as well. So there's a few layers here, but I want to get into the details of why this would be very inflationary for the US consumer. And the Democratic Party in the US has just lost an election because of inflation. I'm sure Donald Trump understands that pretty well. Does he want to go in that direction and create inflation? I don't think so. Before we get into the details here again, maybe if you're maybe you haven't studied economics or finance out there, but tariffs are not paid by the exporters. All right, tariffs are paid by the importers. So if I'm a US firm and I'm importing stuff from abroad, let's say I import raspberries from Mexico. Then if I import raspberries from Mexico and I'm a US firm and there's a 25% tariff, I am the one paying the 25% tariffs to the government. It's not the exporter that pays that. So I have a few options here. I can say to the exporter, say, hey, I need to pay this tax now. I want a better price from you. Maybe there's going to be some concession there. Maybe I can take a hit on my profitability, or very likely I pass on the bill to the consumer. So it's inflationary. It reduces the profits of the importer, and the exporter also takes a hit. So there's a chain there. So you do hurt the exporter, the other country, but also there are hits internally that happen to the consumer and to the importer. It's important to understand that, why it's inflationary. So let's look at the week's markets here before we get into more numbers here. So very positive week overall. TSX S&P 500 bond market, positive returns for a bond portfolio rather. Negative on EFI, negative on emerging market, but still the surprise, at least my point of view, I wouldn't have expected at the beginning of the year that we would have 25% return on the S&P TSX, just 2% behind the S&P 500, given the AI team that we've been discussing all year. At some point this year, the TSX was lagging the S&P 500 by 10 to 15%. Now it's almost neck and neck, so very, very good vintage. We still have a month to go. It's going to be likely a volatile month with Donald Trump tweeting, central bank decisions coming, more economic data ahead of us, but still we're almost at the end of the year here, so it's looking like a very solid vintage for 2024. Price of oil lower as we have this ceasefire that didn't last long, but at least the intention is there in the Middle East. Canadian dollar was down a little bit because of the tariff threats And the price of gold also calming down in geopolitics was detrimental to gold here. So now that we have this out of the way, let's look at hard data. So I was on the road, just a disclaimer, I was on the road most of the week, so I've used some charts from the Wall Street Journal and Goldman Sachs here. It's not really our charts, but still, you can have the sources at the bottom of each chart. So let's start here with some material from the Wall Street Journal. The trade relationship between the U.S. and China, Mexico, and Canada is very important. Here are the value of the imports by the U.S. by country. As you can see, it's between $1 and $1.5 trillion, the value for the imports from Canada, Mexico, and China. So it's pretty sizable. Now, if you look at the breakdown, and here we'll go by country. So the first one here is Mexico. On the left, the next three slides will be structured the same. On the left, you have the value of imports in billions by category, and on the right, you'll have the share of the U.S. category of imports from this country. So as you can see, the US imports a lot of small engine passenger cars from Mexico, PCs, and after that, you have vegetables, you have TVs, and then you go down and it's the grocery basket mostly. And on the right, you see that, well, among the imports that the U.S. does for passenger cars, Mexico is rather small, sizable, but rather small compared to other categories here, like PCs that are manufactured in Mexico, TVs, and then after that you have a lot of food. So here, U.S. producers U.S. importers cannot easily diversify away from Mexico. There's a reason why these things are produced in Mexico and then exported to the U.S. is because of relative productivity. You have those economies of it costs less to produce in Mexico and then ship to the US rather than having to build in the US. Wages are lower in Mexico. The technology, the factories are already there. So let's say you want to diversify away from Mexico and say, right, these PCs will be built in the US now. So you cannot just, snap your fingers like this and have the factories in. You're stuck with the imports from Mexico for a while unless you want to invest and reshore all of this production in the US, and it takes some time. So PC prices will be going up if you have this. TV prices will be going up, and for the all of the other components here, the vegetables, the fruits, beers, tequila, all of these elements, prices will be going up. So inflation in a very sensitive place in the wallet of consumers, which is the grocery store. So you have this. So the tariffs on Mexico have a direct hit on the grocery bill. China now, the next page, smartphones, laptops, and tablets. Batteries, toys, video game consoles. So again, all of these categories here would be impacted very directly, because it's not true that the US will just turn around and start producing smartphones in the US. The cost would be astronomical versus what it costs to produce in China and then import from there. Same thing with laptops, tablets, batteries, video game consoles. So you cannot diversify away from the manufacturing sector that is well installed in China, which is more efficient. The economies of scale that they have, you cannot diversify away from that. So that would be a hit. After that, from Canada, you have crude oil and natural gas and lumber that are very important elements here. Just maybe tongue in cheek here, also frozen French fries. So the price of fries would be going up. But if we're serious and we focus on oil, natural gas, and lumber, there's a reason why the US imports oil and gas from Canada. The pipelines are there. The refiners are geared to refine Canadian oil, especially in the Midwest, the region that we call the PAD 2. The pipelines go from Canada to this region, and they are geared to process heavy crude, the grade that we produce in Canada. We cannot just diversify away and say, right, we'll stop importing from Canada, close the pipeline, and then use some lighter grades of oil, of crude from the US. You cannot do that. You would need to invest, and you would need to re-gear all of those refiners. So in the short run, you cannot diversify away from Canadian oil. One thing that they could do is they could find maybe some Saudian oil and import that instead, but but importing it, shipping it, putting it on rail, bringing it to the Midwest, it's not really efficient. So in the long run, for sure, you can diversify your way, you can change a supply chain, but in the short run, that will likely mean that the hit will go directly to the US consumer through higher gasoline prices. Doesn't really make sense as an economic policy. Natural gas, the same thing. The pipelines go from Canada to the US. You cannot easily take natural gas from a different region of the US and just reroute it to a different region. You would need to build the pipelines. You would need to build the capacity for transportation, and you cannot do it like that. So again, it's not easy to substitute. Lumber now, the US imports a lot of lumber from Canada, so prices for home construction would be impacted, but not just that, framing, flooring, building interior details, cabinets, furniture, so you have all of these elements here. So again, this is just I want to stress this very strongly. The price is paid by the importers, and then after that the bill needs to go somewhere. The money goes to the government, but how do you pay for that? Likely you pass it on to the consumer. It's not true that they will stop buying our stuff like this. In the long run, of course, it has a very important effect, but like this, it's not true. Now, if we make an even deeper dive into the Canada-US trade relationship, here, this is a chart from Goldman Sachs. I'll bring your focus first on the darker shade of blue line on the bottom. This is all goods and trade balance, and this is from a US perspective. So it's a negative number, meaning that the US imports more from Canada than it exports to Canada. This is, it's true that that we have a trade surplus with them, and that's one of the arguments that Donald Trump tends to make, that he wants to attack those that have a trade surplus with the US. But if you take away the lighter shade of blue line, which is the oil and gas trade balance, because this is how the supply chain is integrated in the US, and you look at what's left, the trade balance excluding oil and gas, so oil and gas, meaning that it's goods and services, you have a surplus, and a pretty constant surplus. So we're already importing more from the US than we send to the US when you exclude oil and gas, so energy. So we're already there. So the argument that we're running, we need to buy more from them, and they need to incentivize us to buy more from them, doesn't really make sense. We're already there. Also, the political machine is starting to get going. As I mentioned, we're seeing that there's some articles this morning, on Friday morning, saying that Canada is set to announce border security measures to address the concerns on illegal immigrants. So this is starting to move. There was a call between Mexico's President Sheinbaum and President-elect Trump about, all right, what can we do about the border? And Mr. Trump, using the superlative, saying it was a wonderful and very productive call. So again, things are getting into motion. Will we get these tariffs, or will this lead to negotiation and in the end other kind of deals, and it will avoid the tariffs? Well, it seems likely to us. And here's the last chart that we'll be bringing. This is also the initial market reaction. Market seems to be calling the bluff. On the left, you have the Canadian dollar, pulled back a little bit initially on Monday night, and then regained some of the lost ground. So not much of a move here. TSX is a bit more complicated. I'm bringing it here, but the momentum that we've seen since the summer on the TSX has a few roots. Of course, global equities are doing well. This is a good seasonal period for the S&P 500 because of buybacks, and seasonality is strong. That this carries global equities higher, so there's this tailwind that's there. The sector rotation towards more cyclicals is helpful for the Canadian stock market. There has been some pockets of weakness this week in reaction to that. Rails, because of expectations of lower trade volumes, were under pressure. For sure, manufacturers were under pressure. Auto parts producers were under pressure as well. But other than that, we're not really seeing any kind of reaction. So tail risk, very high impact policy that has for now what we believe, low probability of happening. Market is there as well. Let's not be complacent. Let's continue to discuss it. Hope that the governments are doing what needs to be done to avoid this kind of situation. But from where we stand, we think it doesn't really make sense economically to go there. But let's see how things unfold over the next 2 months until Donald Trump takes office in the US. So what we'll be watching next week, a net change in employment and the unemployment rate in Canada. In the US, we'll have ISM manufacturing, ISM services. Manufacturing sector is still hurting. It's expected to catch up a little bit, but let's see what happens. And then we'll have the jobs report. Still lots of volatility on the jobs report because of the hurricane season, strikes we've had at Boeing on East Coast ports. So maybe the signal is a bit more muddy here. So let's see what we have next week and how the market reacts. So that wraps it up for the week. Always a pleasure to serve you. If you have any, if you appreciate the content, please share. And of course, come back again next week.